Good afternoon. Good afternoon. We are doing our fund update call for the month of October. Just to tell you, hi guys, how we're doing so far. We're doing quite well. We're up on the index about 5%. I'm going to preemptively speak of performance. Performance has been really strong this year, but we'll get into the nitty gritty of this conversation, this topic, and also the performance. Matthew, are you there?
Yes, I am. I'm here.
Excellent.
Hopefully you can see me, and
Yep.
we'll start this just now. So, guys, thank you. If you could someone just allow me to share my screen, that'll be
Yeah,
great.
absolutely. Yeah, you go ahead.
Awesome. So I think it's this one we're going to share. So hopefully everyone can see this screen. Okay. All right. So the 29th of October, our fund update call for the month. Thank you for joining us. So it's me,
Couple
Omar.
days before Halloween, Matthew.
Yes, a couple days before Halloween. So um, there's always a tentative time in the market for people that run money and manage money because, quite frankly, you want to have a good showing at the end of the month because end of the month and end of the year count, right? And
Mhm.
uh, you know. I joke with Omar and say no one cares how you did it on January the 2nd. People care how you did it on on December the 31st, right?
Yep.
And the same thing, like for the month, everyone wants to know what you did on October the 31st or September the 30th, et cetera, right? So, anyways, and quite frankly, guys, that's probably the wrong way to look at this thing. It's probably totally wrong to look at it like that because you should look at this over the series of quarters or years, not over the series of like weeks and months, right? But that is a human emotion that people kind of strive for, right? And you have to say, hey, listen, this is a investment mandate, and this is what we do, and hey, if the stars align to have a nice piece of performance at the end of a period, well, then so be it. But that shouldn't affect the investment mandate. Okay, so let's talk a little bit about this. We wanted to comment
It's a
here.
very important topic as well, Matthew. I was going to say it's there's a lot of talk right now about artificial intelligence and there being a bubble and all that stuff. So we're going to look at the actual return on investment. So Matthew, let's get into it. What is the return on investment in the artificial intelligence spending? Because every day we see a headline article from either AMD or Nvidia or Facebook or Amazon or Microsoft. Someone is talking about how much they're spending on artificial intelligence. So that's
Right.
what we're going to take a look at today. So guys, let's get into the nitty gritty. Let me take it over to Matthew.
Yeah, so I mean, what we've heard about this in the news a lot. It's like, okay, well, what's the ROI? We're spending, 80 billion for Microsoft and Trump raised half a trillion and this company's like, especially this like what a busy week we've had. It's just Wednesday and Amazon lays off tens of thousands of uh people, and then you see like Nvidia having some partnership news, and things that seem to happen pretty quickly, right? But also there's an undercurrent of like, hey, there's so much spend, what's the ROI? And we thought we spent a little bit of time on this and just kind of walk this through. And I'll caveat that this is still early days, right? This is a new industry that's obviously building on technology, but like we do need to, I'll take the data with a pinch of salt. We're just going to kind of see what the thought leadership here is, and if we agree with it or not, right? So, AI market will grow almost 50% year over year to nearly 1.5 trillion in 2025. Cloud data buildings and escalating enterprise investments, and you see that, right? How do you think a company like Amazon or even Microsoft was able to shrink their headcount by that without doing these things, right? Like that's going to be a byproduct. um, Enterprise AI adoption includes small businesses as well, makes up a good chunk of money. 70 to 77% of the total AI spend. That's interesting, right? But it is kind of it does follow that, hey, listen, like small businesses make up the bulk of employment, right? Because there's just so many of them. But you see a company like Amazon, I think they employ like 1.5 million people globally. Like that's crazy. Like one company employs like more people than live in the city of Mississauga. Like think about that. It's a crazy stat. So imagine everyone in Mississauga just worked for Amazon. plus another half size of it. So it's like all of Mississauga and maybe all of Hamilton. They all work for Mississauga. They all work for Amazon. Like that. That's the size of it. So it's pretty crazy if you kind of put that in perspective. But then again, the flip side is, small businesses make up such a big spend as well. So the number of small businesses, maybe they don't employ so many people, but on aggregate, when you add it all up, they do account for the lion's share. So, GPUs, hyperscaling, very large range. Let's just call it 400 billion, 23% of the AI spend, right? And yeah, we have many different pieces of the pie here, right? And we can just see, like, listen, like, AI takes a lot of effort, right? And it's going to take time to solve. And there's a lot of intricate and overlaying kind of concepts here, right? And return doesn't always mean top line, right? It could come from new products, which is sellable features or subscriptions. Like I have a subscription. I'm pretty sure, like if you do the math, think about like supposing every office employee has a AI assistant. Like what does that equal, for a chat GPT or for a Gemini user, et cetera, et cetera. Like what happens then, right? What happens if you have a work one and a personal one? So and this is just on the subscription matter, right? Who knows what else there is, right? Better monetization. Personally, I'd hate to see ads come to AI. That would be terrible, but we'll see what happens. Efficiency gains, yes, it cuts labor. I've experienced this myself. Many of my colleagues have in the industry and whatnot. And this is the new world order from that perspective. And reduced mistakes. Yeah, there could be some reduced mistakes, but AI does make mistakes on its own as well. Okay, but of course we are going to have savings net. I think that is accepted by most of the industry. Okay, so right now a lot of this is the heart of the matter, right? Right now, people are saying, "Oh, well, we don't know if it's going to make any money, this and that." It's like, and why did they say that? It's because it's all supply side, right? It's like it's great that Nvidia is selling a boatload of chips every quarter to very very other large companies, and that's very good. Okay, that's very good. Okay, but it's like, okay, well, when those large companies buy these chips, how are they going to profit from them? And that's the whole ROI kind of debate here, right? It's a rather cool looking room here. When I first saw this picture, I was like, "Oh wow, this is right out of like a Terminator, right? Like these long rooms of these computers and processing places. Like everything is turning. Is the world going to turn into one giant computer? I'm saying that tongue in cheek, but interesting graphic there. Okay, so the old cloud model that was before, and we have Amazon, AWS, Microsoft, and Google, and these are the main cloud service providers, and each of these are going to be using AI as well, right? And I bet you, like if you work at if you're in an office environment, or even if you're not, there's a high likelihood that your company is using one of these. Or if you're a small business, high likelihood that your company is using one of these. Like so yeah, it is pervasive, right? Lots of services being purchased, renting that computer power to enterprise as cloud services, also known as infrastructure as a service. So these big tech firms minted the term and basically created interesting software as a service. Now you have infrastructure as a service, right? And that's how that's how the ROI models could do initiate. So new cloud model, now those same companies still build massive AI optimized infrastructures, but instead of renting most of it out to customers, they're increasingly using it themselves to train their LLMs, right? Power the AI, provide services, fine tuning, and again, AI powered software as a service, right? So multifaceted type of usage there. Okay, so they'll sell models, APIs, apps built on top of the models, developer platforms, which means they have layers of multiple revenue streams, right? And we have a little example here. If you rented a GPU, it might cost you $2 to $5 an hour, but using an LLM plugin, it can cost $10 to $100 per token, and that's a very specific term. Like for, and you know, the example is, you know, Copilot license could cost you between $30 and $50 per month, right? And that adds up. You know, if you have, say, you have a license pack for your home, maybe one or two users there, then at work you have another one as well, or and maybe they're going to be specially designed AIs, right? There's that as well. So certainly the ability to create more revenue streams is what the market is looking for, quite frankly, right? Because this is becoming a much asked question in the media now as well, right? And now is that going to be the catalyst for some kind of slippage? I don't know, right? But I do hear people saying, "Oh, there's going to be slippage," and I hear, you know, later on in the same day, "Oh no, you know what? The AI is not a bubble. All these companies are making lots and lots of money, and you know what? I'm going to stick to watching the news, analyzing it, and stick to the company's fundamentals that I'm looking at. And if I see the earnings slip, then we're going to have to make some decisions. But if we don't see the earnings slip, we're going to continue on business as usual, right? And I think that's a rational thing to do. Let the numbers speak for themselves. You know, uh, incorporate qualitative features that are well supported, and I think that's the most appropriate approach. So the old model, bank rents GPU compute from AWS to train models. AWS gets revenue from compute only. New model, you know, the AWS builds the model using its own GPU, then sells it to a various number of people, and you make this, you know, same hardware, but you know, this could be multiple times the revenue per unit, right? And that creates a heck of a lot of economies of scale, right? So uh so yeah, so you know, this is building the case for, yes, there's a revenue model for the purchasers or the demand side of AI. Okay. So if you look here, you know, estimated ROI, 1 to 2 years, 5 to 15%. Cloud could climb to 20 to 30% as platforms mature. Exception, Meta ads already seeing double-digit return on AI investments in revenue yield, right? And listen, like people have jumped on the bandwagon already saying, "Hey, listen, I can get your AI up and running. You need the specialized AI." There's no shortage of people and companies that are now have specific, like, you know, very specific AI solutions that they want to sell you, right? Excuse me. These are demand side. So AI enterprise AI. These are demand side adopters from AI platforms, consultants, infrastructure, and tools. Most enterprise AI projects fail, but those that make it, the outcome is very good. Okay, the outcome is very good. So, you know, you may not catch a lot of fish, but the fish that you catch, they're going to be great fish. Okay. Here's this kind of case in point here. Successful deployment, 15 to 40% ROI in the next 12 to 24 months. Extreme cases, 2 to 5 times ROI. They describe two different parts of the funnel. Deployment rate is low, but success after deployment is high. So again, the few that do make it, very, very successful. Okay. Why most AI projects die before deployment, right? And yeah, like this comes down to like an R&D issue pretty much, right? Like, you know, the certain organizational barriers, data infrastructure barriers. You gotta build this out. Governance is obviously going to be key. Privacy is going to be key. Talent and ownership gaps, and obviously change management failures. Right? Like, you know, this is a new technology which is being rolled out at a rapid pace, like a rapid pace. Right? I mean, I'll be honest with you. Like, I'm seeing, you know, how many people here, and I'll put my hand up as well. How many people here are seeing more ads on,
Every day, Matthew, you see them more and more.
yeah, related to AI versus anything else? You're seeing them more related to AI,
Mm-hmm.
right? Rather than, hey, take this course, or like, hey, I'm a fitness influencer, or I'm this or I'm that. I'm seeing more and more AI related stuff. Now, of course, you know, that algorithm is geared for me, but you know, that is the case, right? Okay. So creates a misleading perception because yeah, there's lots of money being spent, but because headlines show huge AI spend, 1.5 trillion in 2025, but ROI lags heavily. The market's not going to really like that type of concept, but it does want to see some ROI there, right? However, you know what? Is it just like the dot-com crash? Not necessarily. Uh, you know, cloud migration, 70% early failures, now $500 billion market.
Matthew, I would say the biggest difference between now and the dot market crash, the dot-com market crash was those companies were a lot of speculation and hype, not necessarily earnings. The companies that we invest in today, they already have massive earnings. They are now looking to expand those earnings. That's the biggest difference.
Yeah. So AI is following a similar S-curve pattern, 90% failure rate to projects, not companies, right? So think of this, I'm looking at this and I'm thinking like this is like an R&D type of thing. Like not everything you invent is going to become, the next big thing, right? But maybe one out of if five every 100 or one out of every 20 are a success, then yeah, that's what these numbers are saying. But these are projects, not companies, right? So, the two that in this example, 10 AI initiatives, 8 of them fail, 2 succeed, but the 2 can generate like a 10x in terms of the investment there, okay? So, McKinsey is warning a $13 trillion annual GDP uplift by 2030. That is gigantic.
Yeah, that's gigantic.
But like, we're just throwing some numbers out there. But as I said at the beginning of the session here, I would take all these numbers with a pinch of salt because like you don't know what, we have a reasonable idea, but that idea is changing as news come out, as we learn more, as the companies at the helm of this industry, make new inventions and release new products and services. It is a growing kind of thing, right? And from our fund perspective, we're very cognizant, okay, where's the AI spend happening? Who's on the supply side, who's on the demand side, and if you're on the demand side, where's your ROI? Where's your ROI coming from? Are you expecting to have one, right? Because we certainly don't want the case where we're going to try our best to avoid the case where, oh look, they spent all this money on AI and didn't get any benefit. Well, what the heck use is that, right? So that's something that we are constantly kind of monitoring for because I think it's really important that we do that. Okay. Now that being said, on the actual equity market side, like
Market's been on fire late, Matt.
you may have noticed on your account, both in the Theta Alpha Fund and maybe your personal trading accounts that you maintain,
Well,
that
much more so on the Theta portfolio, Matthew, as opposed to the actual market itself. We are outperforming the market by a long shot, but we'll get into that a little bit later on.
yeah, we'll get into that later on. But the market is going up, which means that it is still bullish. And what do people say? The market climbs the wall of worry, and this is indeed like a wall of worry. Like, look, like the S&P 500 is about 5,000 earlier this year. This is after the whole kind of yes, the tariffs are coming. The tariffs are coming. This is what happened at the beginning of the year, and now
And Matthew, we were buying aggressively when it went down all the way down to 5,000, right?
yeah. And now it's about 6,700, right? So certainly, solid performance there. Okay. Here's the NASDAQ. It's much the same chart, guys. The scale is different though, but it's drawn as much the same chart. But if you look at, what's 6,700 divided by 5,000? Is it
It's almost it's actually 1.374.
right? And if you take 25,000 divided by 17,000,
1.8185.
yeah, okay. So like, it's the same kind of configuration of the chart, but the scale is different.
Yeah.
Right. And why is the scale different? Because you have more risk, so you have more reward there as well. Generally speaking, that's it.
Yep.
NASDAQ is definitely going to be deemed as a more quote unquote risky index than the S&P 500. Why? Because they have more innovative companies there, or companies that are innovating more, you could say, hence more price variability. And also it's 100 companies versus 500 companies. That's another reason, right? So, that being said, we've carved out, and why do we put S&P and NASDAQ here, guys? it's, you know, our official benchmark, guys, is the Nasdaq. Okay. And because we have mostly Nasdaq related stocks, but do we have S&P stocks in this thing? Yes, we
Of
do.
course.
But we're not going to
Yep.
go down the road of having this kind of combined benchmark. That's going to add confusion, and we want to kind of avoid that. So we say no, no, we're going to, you know. But the main thing about the benchmark is that it's relevant and it's consistent, right? And you know, the Nasdaq is relevant and it is consistent. But you'll see some of these stocks here. They don't trade on the Nasdaq, but that is our benchmark, and that's why we show it to you. So this is as of what is that? 2 days ago, 27th? Yeah,
Yep.
2 days
Yep.
ago. Uh, you know, we're quite comfortable with these levels of exposure. We are trying to get into certain number of these stocks a little bit more heavily, but we are trying to leg in them, and that's where options really play a very efficient role, because we just don't, like, you know, we don't really say, oh, well, we need allocation of 10% to, you know, this stock and this simply go and buy it. We'd like to leg into that at the prices we want, and we may as well get paid to do so. So that's why, you know, we'll incorporate an overlay of naked puts or written options to get that. Okay. So yeah, that's the portfolio there. You can see our leaders here are basically Microsoft, Tesla, and AMD, uh,
Yep.
and double, you know, inching into double digits there, and you know that is driving a chunk of performance. But you know, even some of our smaller holdings are, you know, they're decent allocations to that, right? And we, you know, we have the freedom to move around within this sandbox, and we like that, and it creates for good positioning when we see the tactical opportunity, right? So we're quite pleased there. We've incorporated Broadcom a little bit as well, because you know
That's a
that is
new
part of the
position.
Nasdaq. And we're not going to try and, you know, match the index. Absolutely not. This is not the way to match an index with like, you know, 14 stocks, and only I think 11 of them are actually trading on the Nasdaq. So it's really not the if we're trying to hug the index, this is not the way to do it, guys. So we don't be called index huggers, because this is an actively managed portfolio, and you know we you know that's it's a strong feature of this product, right, which we take very, very seriously. Now you know here that we have about 4.2% in cash. That's actually gone up. I think I was looking at there, it's actually north of 5% now. And the
Almost
reason why we're
6%.
doing
Yep.
that, guys, is because if there is a downturn, like we've seen what this chart looks like, you know, this is indeed, you know, tongue in cheek, the Nasdaq climbing the wall of worry. And if there is a downturn, hey, we want to take advantage of it, and we having a cash allocation of over 5% is going to allow us to do that, right? So yeah, and that's literally the reason why. So if you have any questions about this, let me know. So here, you know, we have about 5% put exposure, most about 90% in long exposure, solid 5.3% in cash. Um, and yeah, like here are some returns.
Some pretty good number.
Year to October 27th, we're outpacing the Nasdaq by about 5%, 5.09%.
Well, what matters most, Matthew, is 24.52%. 24.52%, guys. That's a
Yeah.
huge return. And compared to the NASDAQ 100, as Matthew was saying in Canadian dollars, it's 19.43%. So we are beating the index net of fees by almost 5%. That's a big deal. And we're
Yeah,
very proud of
and
that.
we're very proud to say that, you know, we've been beating this for a chunk of months this year, right? So, you know, and that's very good. Like obviously past performance isn't a necessarily indicator of future performance, but you know, it is our job to actively manage this portfolio day in and day out, to make sure that we are doing our best to achieve the mandate, right?
Mhm.
And that's what we've been doing so far. Okay. Um, so again, here, guys, if you are interested in the fund, yes, you can uh, hold this in your RSP or your Lira. We can take registered money. Um, you know, it is a higher risk portfolio, absolutely. So we do assess that high, and you do need to have a long-term time horizon. And that's because we have investment theses which are playing out over a number of years, because they're at, you know, they're innovative companies, right? Like we are in
Mhm.
AI, we are in electric vehicles, we are in cryptocurrency, we're in healthcare,
Cloud,
we're in energy,
yeah,
right?
web services, etc.
Yeah, et cetera, right? So yeah, like these theses are going to take a little time to play out. Okay. So yeah, if you're accredited investors, SMAs, portfolio managers, all are able to purchase the fund. What to look out for November? You know what? Like seasonality hasn't exactly been the best indicator this year, guys. Not at all. But that
Mhm.
being said, I do have to say, we did some research. Me and Danielle did some research earlier today, and the last time the low and the so two stats which really stuck out for me this last uh just now. One of those was the worst return of the last 10 years was still positive for
Mhm.
November. Okay.
Mhm.
And apparently that's including 2022. Okay. And I think in 2022, if memory serves me correctly, did have the lowest performing month, but that was
Yeah,
still
perhaps not people like, yeah, absolutely. Where you live, yeah, that makes
0.02%
sense.
up. So
Yep.
like it basically did nothing, but technically it did improve. Now, the worst performing the worst performing November uh was actually in 2008, where we had
Which is
a
the gold
systemic
bar.
financial crisis.
Yeah.
So we feel quite strongly going into November from a seasonality perspective. But anything can happen. We've had such an awesome run up, but we'll see what happens. Is this market does hit higher and higher highs? Well, maybe it does. But we have to kind of our job again is to take in the information on an unbiased, independent, objective manner and trade the portfolio accordingly. Okay. Again, what to look out for? I'm looking out for this number here, guys. This 2.3%. This is the average S&P
This is that
number.
inflation number. Yeah, of course.
Yeah, that's a positive sign there. However, we have rate cuts, which should help fuel the market on the rate cut and the rate change initiatives, both in Canada and the United States. You know, they are not up in the air, but I think people are going to start paying more attention to what is being said rather than the numerical value by which the rates change.
Mhm.
Okay.
And we had a rate cut this morning in Canada.
We had a rate cut this morning in Canada. Okay. So, and we have to look at see, okay, what did Tiff Macklin say? And that's really when rate cuts happen in Canada, it's usually pretty like insulated news. It doesn't like, I'm sure other countries pay attention to it, but like if you're
Yeah.
in that,
It's not
if
as
you're
big a
in
deal.
the industry, but generally speaking, it means more to Canadians. Whereas, in the United States, if this rate cut, like the whole world hears about it, the whole world really, really cares, right? And I think, in Canada and obviously abroad, when the United States cuts rates or if they cut rates, or at the rate cut announcements, what is being said is going to be weighed at least as much as the cut itself. Okay. And if there's no cut, it's definitely going to be what's going to be said. It's going to be paid a lot of attention to. Okay. So if you have any questions, you can contact Omar Khan, myself, or David, and we'd be happy to speak with you. I know a lot of you have spoken to Omar. Some of you guys have spoken to me regarding KYC concerns or concentration limits, basically onboarding. But please do let us know if we can do anything for you, and if you have any questions. I will leave this disclaimer as required by our regulators and our compliance team on for a little while here, guys. And yeah, if you have any questions, do let us know. This will be put onto YouTube over the next couple of days. And thank you for joining us. Thank you for your support if you're a unit holder. And wish you a great afternoon. Any questions here, guys?
See you guys.
Okay. All the best, guys. We'll talk to you.